What is up, everybody? Welcome to day 4 of the Limitless Trading Bootcamp. Today we're talking about price action, how to read the market with only candlesticks. Nothing but candlesticks. You don't see anything else on my screen. We're going to be going over how to read the market with only candlesticks because the goal is to build raw market reading skill and understanding. Now, this is the foundation of how the market works. Like we've talked about in the previous videos. If you haven't watched those already, please do watch episode 1 through 3. It's very important to watch this series in chronological order so everything makes sense and fits together cleanly. Now, price action is super important. Like I just said, and how we've gone over in previous episodes, it's the basis of how the market can be understood. It's the language and how the market is communicating to us, right? We have to learn that language. We have to understand it. We have to speak it, right? And so by doing that, we need to develop the skill of reading and developing the knowledge and understanding of price action, right? So with this episode, what we're going to be covering is the makeup of a candlestick, right? Now, it may seem simple enough, but giving you the true understanding of why each part is important and what it can tell you, right? Then we're going to talk about acceptance versus rejection. We're going to be talking about continuation versus reversal behavior and just candlestick behavior in general and what it means, right? And then why patience beats prediction, why anticipation should be our main goal instead of prediction, right? These are all very, very important parts of the episode. So like we always do, and always talk about before we start and get into the episode, get a drink, get a snack, get your notebook, make sure you're writing down detailed notes so that you can refer back to them later on. But we can get right into it. Before we do though, we are getting closer and closer to my one-on-one mentorship that's dropping. Now, this is a genuine one-on-one mentorship. You're not thrown in a group and expected to just watch YouTube videos, right? I'm gonna help you on a personal level, and I really want to help the right people who are willing to take trading seriously, right? Who aren't on their 7th mentorship, strategy hopping, right? I want somebody who's serious about really learning the ins and outs of both how the market works, how to use the back end of the market and orders and liquidity and real simplified order flow to help them advance their trading, right? To cross that bridge from unprofitability to profitability, to stop over trading, over leveraging, and stop just completely putting an end to all the mistakes that you're cognizant and aware of having, right? You're making mistakes. That you're self-sabotaging, right? I want to help you overcome that and give you the right tools and blueprint to actually turn you profitable. So if you're interested in that, we're getting it every single day, getting closer and closer. There is only a few people that we can't take on because I want to give personalized mentorship to each person. So I can't do that with a million people. So if you are interested in that, it's the first link in the description down below, but we can get right into this video. Now, the first thing is the makeup of a candlestick. Okay. Make this large enough, right? We have our body and we have our wick, right? Two major parts, our body, and then we have our wicks, both marked as 2, right? These are the 2 parts of a candlestick. More specifically, right, we have our open, we have our close, we have our high, and we have our low, right? So technically 4 parts, but we're going to dumb it down to 2 parts, the body and the wicks. The reason why is because these are the main 2 things that tell you the whole story of what's going on inside the market, right? Now we'll treat this as a bullish candlestick because the rectangle happens to be green, right? But what this can tell you, it can give you a lot of context, right? And putting it together across every single candlestick can give you a lot of context. Okay. So if we're trading and let's say we're in an uptrend, right? We're seeing continuously higher highs, higher lows, right? Whatever the case may be. We're in a strong uptrend. We're seeing bullish candles being made, right? That gives you good confluence and agreement. All the activity in the market can be essentially deciphered through a candlestick, right? Now, you're not going to get the more in-depth look by looking at order flow and things behind the scenes as well, but the actual result of what happens on the back end can be seen within a candlestick, right? Like I said, you're not going to be able to get that more in-depth look to give you the more minuscule and finer view into the market, but you can at least see and anticipate what can happen next based off of the strength of buyers and sellers. That can be told by looking at a candlestick. So if we had a candlestick that was like this, right? Eliminate these. Let's say you had a candlestick that looked like this, and this selling wick came down a lot farther, right? Well, now what this is telling us is that compared to the previous candle, we had a lot more selling pressure within this candle, right? We might have closed green. We might have something that looks like this, right? We might have closed green, but significantly, right, what is most noticeable in this candle? Well, that's the selling wick, right? The wicks essentially tell you where price traveled, right? Imagine this is a 1 minute candle, right? Terrible handwriting, I'm sorry. But imagine this is a 1 minute candle. Within the entirety of that 1 minute, price opened here, was able to travel all the way up here, all the way down here. But ultimately, at the end of that minute, we could only make progress definitively within this range and close here, right? So the attempt of buyers failed. Buyers attempted to bring price here to close price here, right? Wicks will do the damage, but the bodies will tell the story. You might have heard that before, right? So the attempt of buyers to push price up here was unsuccessful, and the sellers brought price back down a little bit more closer to open, right? Now, a lot of people get confused. They're like, well, it closed bullish, right? So that means that overall buyers had strength. Yes, that may be true to an extent, right? But you want to look at the broader picture, right? And simply, like I said, looking at wicks and bodies can tell you a lot, right? But there's a sequence, right? Sometimes you want to look for a sequence in candlesticks to kind of tell you and give you a little bit of more information. For me, I kind of look for what I call a 1-2 punch, right? Which we'll go over in just a second. But before we get into that, considering what candlesticks will look like, right? Whether this is, let's say we have no wick, right? We have a candlestick that looks like this, right? Now, on the contrary, what does this look like, right? We opened up here. Sellers tried and they attempted to bring price all the way down here, and they were unsuccessful. And so in turn, the buyers were strong enough to bring price all the way back up above the open and close. And most of the time you won't see one without any type of selling wick, but we'll just say we had a minimal one, right? So what this is telling you that buyers were very, very strong. Not only were sellers attempting and they were unsuccessful, but buyers immediately pushed them back up. The fight that they had within this 1 minute candle pushed price all the way back up and got us a strong close, right? Does this automatically mean that we're going ahead even higher? No, but it gives you a clue that buyers at the moment have the market, right, in its control. And this can obviously be paired with the overall trend and so on and so forth. You want to pair it with other confluences like structure and trend, things like that, right? But just looking and really understanding what a candlestick is telling you, what a candlestick means, is super, super important, right? If you have a bearish candlestick, we'll change this to red just for the sake of it, right? We have a bearish candlestick that looks like this in like manner, right? We have a strong selling wick and a very minimal buying wick. Well, in this case, vice versa to what we just saw in our previous candlestick, right? Buyers, they attempted to push price all the way up here. They were unsuccessful. So sellers were successful, were able to bring price below the open and have a stronger close that indicates that sellers have the market control at the current moment, right? Now, typically you don't want to take this individually and have tunnel vision with each single, candlestick. That's why we say have additional confluences, right? But that's why it's very, very important to look at the broader picture, right? The overall structure of the market, what is telling you, are we ranging like this, right? Are we trending? Right, that's very, very important. So just simply by looking at the wicks, the bodies, the strength of each one, right, can tell you a lot. Same thing with having a candlestick that shows a lot of indecision, right? Like a doji candlestick, right? We had something that looks like that, right? And we had something that looks like this, right? This is a lot of indecision. This is telling us that both buyers and sellers were unsuccessful in trying to push the market. Right, we opened up, buyers attempted, sellers attempted, and both were unsuccessful. We immediately essentially closed right where we opened. So what that's telling you is that there's indecision in the market, right? Now that fight between buyers and sellers is pretty equal, right? It's pretty level. And so the next candlesticks can tell you a lot about what's going to happen. You might see a doji at a high or a low, and we might see reversal ensue after that, right? Or you might see price start to consolidate, right? And then we'll break out to either direction, right? There's a lot of different sequences in the market, but just analyzing the anatomy of a candlestick can tell you a whole lot. So now that we know both about wicks, we've kind of spent a more majority of the time on wicks, right? But now looking at a stronger body, right, with minimal wicks on both sides, right? What can that tell us? Well, overall, like we talked about, wicks will do the damage, but the bodies will tell the story, right? This is a pretty strong indication that sellers are in the market, obviously, right? And here, we can create a lot more bigger moves, right? When we have stronger bodies, a lot more volumes coming into the market. This essentially is telling you that there's a lot of participants that are actually coming into the market. When you start to see volume open up, you start to see it, like for example, you start to see maybe 10, 20 point candles on NQ printing, right? And then you see a 40 point candle like this, right? With sellers just immediately coming into the market. That's telling you, okay, volume's coming in, participants are waking up, the market's getting more active, right? And now you can base your next decision anticipating what's happening next, right? Based on the structure of the market, the trend, all the context you can take from both the anatomy of the candlestick to the behavior of what's going on, right? You can put those clues together. So now we can kind of talk about that a little bit more. We've already talked about the makeup of a candlestick, right? Now we're going to talk about acceptance versus rejection, right? Now, today was a half, or what is this? This was on Friday, excuse me. This isn't even today's price action, but let's just go into something like this. Okay, kind of shows a little bit about both sides of the market, right? We're able to see consolidation. We'll mark this a more neutral color, right? We're able to see consolidation in the market, right? We're able to see a more trend-based market, right? With this, we'll mark like this. We're able to see a more trend-based market, and then kind of see some more tighter consolidation, some more minuscule moves, right? And even with this, you can tell a lot about the market. But remember, you want to kind of break it down from the overall broad view into the more minuscule view when you actually zoom in and look at each candlestick, right? So looking at the structure and looking at based off if you're a reversal based trader, if you're a continuation based trader, you want to be able to use those conditions to your advantage. If you're a continuation based trader, you're obviously looking for a trend, right? If you're a reversal based trader, you can kind of trade reversals in either side of the market, right? If you're kind of ranging, you can play off the top and the bottoms of the consolidation, right? If you have key points of interest that actually align. If you're looking for reversals, even if you're looking at a trend like this, you can catch key points in the market, maybe to catch these pullbacks, or if you're trying to look for the longer term view or the longer term pullback, you could look for those things too, right? Whatever the case may be, whatever the style is, right? Being able to play to your strength. So let's, for example, just consider this trend, right? We kind of start to see that breakout below this low, right? Once we kind of come below here, retest, reject again, we kind of start to see that trend to form, right? Begin to form. So now, looking at the anatomy of each candlestick, what can we kind of notice here? We're going to be talking about acceptance versus rejecting, where the market is accepting participants in the market and where it's rejecting. For example, we started to see that volume come into the market, right? Now, remember, we talked about these noticeable buying wicks at these lows, right? Does this automatically mean, okay, we're going to reverse all the way back up? We're going to completely eliminate this downtrend? No. This is why you want to start to look for sequences. You want to start to look for acceptance versus rejection, right? Now, the market is accepting price lower, right? These sellers are getting strong closes that are sending us lower. When is the first indication that sellers begin to be weak, right? We're seeing strong sellers, right? Buyers attempted, noticeable selling wick, immediate sell-off, strong close. Immediate sell-off, strong close. When did we start to see sellers kind of dry up? Right here, right? Now, we're not only failing to close below the previous candle low once, right? Where we start to see some indecision, right? This is your first signal. This is your first kind of wake-up call, right? That sellers are starting to dry up. Unlike this candle right here, where yes, it did close bullish, right? But you see a clear attempt to where, okay, we tried, we barely closed bullish, but we attempted, right? And immediately, what is it followed up with, right? That sequence, it's followed up with extreme selling, right? Strong close. So their attempt was not accepted, right? Buyers were not accepted at this price. Sellers attempted and they were rewarded. They were accepted lower. Same thing with this candle. Now here, you could say, okay, you could argue that there's a more noticeable buying wick, right? But overall, it is a doji, right? Signaling overall, we made no progress in this candle, right? We had buyers attempting, we had sellers attempting, but we made no progress, right? So what really can kind of give you that indication is, A, we failed to show any close below the previous low, right? We started to see indecision, which if sellers are in the market still, we shouldn't really see indecision, right? We should see that continuation. So that's your first kind of signal, like, okay, it's not saying, okay, take longs. It's just saying, okay, now you can start to see our buyers actually going to give us a pullback. Now you see the next candle. Once again, sellers attempted in this candle, right? We did close bearish ultimately, but sellers attempted to push us a lot lower and we failed. And then once again, failed to close again below the previous candle low, unlike this sequence that we saw that brought us lower. So now you get another indication, right? And what do we see? We see a little pullback, right? Now, obviously, if you're looking for if you're a continuation based trader, right, with this sequence and price action, you're not necessarily looking for, a pullback, because the overall trend is showing you that we're bearish, right? If you're a reversal based trader and you're trying to scout maybe a pullback, then this sequence can be interesting for you, right? But that's the thing that a lot of people mix up with sequences and price action. A lot of people might think, oh, okay, if I'm just scalping price action, I'm not using any type of confluence to aid my decision making, right? A lot of people will go on a big losing streak, right? If they're trying to catch the bottom, right, looking for a bottom of this entire move down, you're going to get burned. You don't want to catch falling knives, right? If you have confluences that support your decision, right? Like, for example, I'm more so a reversal based trader. I will trade continuations. I'm building a model for that. But when I'm trading reversals, right, I'm using additional confluences to aid my decision making, right? I'm looking for orders to get filled, and then with price action showing, similar sequences where I'm able to capitalize on reversals to the upside or reversals back to the downside, whatever the case may be. But when you're just scalping price action, or you're just looking at price action bare bones prior to adding confluences to your chart, right, you're wanting to decipher and read what's going on, what sequences that price is actually showing you, right? And you want to be able to anticipate where price is going next. That doesn't mean you have to take a trade. That doesn't mean that you're trying to predict, okay, we're going to be at this price at this time, blah, 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 blah. No, you're just trying to anticipate. Okay, you start to see the sequence. You're anticipating now. You're bracing yourself that buyers can potentially come into the market. So more so, if you're a continuation-based trader and you're looking for shorts, this sequence is showing you contrary to what you're looking for. So this is more so a warning signal. Okay, if you're looking for shorts, you're a continuation-based trader. Okay, I'm going to wait out this area since price is showing me that buyers are fighting back, sellers are being unsuccessful. Now you sit on your hands in the market, right? Reading price action can do a whole lot of things for you. It's not just to enter into a trade. It's to help you see when not to enter into a trade as well, right? That's why this is the basis of the market, no matter what strategy you use, whether it's ICT, support and resistance, supply and demand, order flow, I don't care, right? You need to have the foundational knowledge of reading price action over anything, okay? So let's continue, right? We start to see this sequence, right, continue. We're seeing some more indecision. We're seeing equal-sided wicks, right, to either side. We start to see our first indication that buyers are kind of strong, right? We start to see a strong bullish candle. And then, but what is it followed up with, right? Are we seeing that continuously? Are we seeing that consistently? No, because we see this candle, we had buyers attempt and a noticeable selling wick. We're seeing that sellers are not having it, right? Buyers are not accepted in these prices, right? We're not getting a strong close again. And what happens next? Now this is where sellers come back into the market. And this is where we're now aligning with the overall trend, right? When you're looking for a continuation, right? You're looking to utilize a trend to your advantage, right? Some people say, oh, the trend is your friend until it isn't. Duh, right? The market can change at a moment's notice, but you're using the context that you have in the market, right? If you're looking to trade with the trend, why would you take a trade contrary to it, right? So utilizing it to your advantage, right? Yes, it's your friend until it's not. Like I said, duh. But this is why you use context clues. You read price action to be able to know, okay, I'm going to sit on my hands. I'm going to sit back. And I'm going to wait for this to actually play out, right? You start to see sellers come back into play. You're seeing stronger closes in the market, right? Now you're starting to see there's a little bit of a fight, right? You start to see, okay, we get another sell-off down here. You might be wondering, well, where should I enter? You're explaining what you're seeing. Where should I enter? With reading price action, like I said, it's the foundation of the market. It doesn't necessarily mean you need to be entering just solely off of candlesticks, right? With any foundation of the market that you're using with price action, You want to be able to just develop the skill of reading it, right? Being able to anticipate what's happening next. If there are some people in the market who just scalp pure price action, I will do that. I used to do that a lot more prior to using what I use now with simplified order flow. I used to just scalp pure price action a lot, right? But obviously adding confluences to it to aid your decision making, to increase your win rate, to have more refined entries, that is obviously the way you want to go, right? But when you're looking at price action, you should be able to anticipate and at least know where price is breaking down. You and anticipate and be correct about your anticipation, right? So at least we can at least refer to it like that. Where can you anticipate where price is going next? This is not meaning, taking a trade or an entry model and things like that, right? But like we talked about, acceptance versus rejection, right? We have wherever I put I don't even know if I put it anywhere. There we go. We talked about acceptance versus rejection. Now, this kind of goes hand in hand with continuation with versus reversal behavior, right? We kind of talked about it and went over it already. But using these two in tandem, this is where we're able to kind of read the market a little bit better, right? Using this reasoning to our advantage. Now, when we're looking at a trend like this, right? That 1-2 punch that I call, right? I call it a 1-2 punch because it's like a sequence, right? You want to basically see in a trend like this, trend down, you want to see buyers attempt, right, and fail, and then you want to see sellers attempt and get accepted or rewarded, right? That 1-2 punch. So where here would you be able to see that consistency and those attempts, right, that align with trend? Well, you see, overall, this trend doesn't really give you any break of lows. We're starting to kind of consolidate, but once we start to break previous lows, right, like we see right here, well, now this is actually a great, example, right? So you start to break a low here, you break another internal low here, strong sell-off, strong selling pressure here that's getting rewarded, strong close, strong selling here. You kind of get a noticeable buying wick, but still overall this body is overtaking that. All right, between the two, you're noticing more so the body that's closing strong, and then this is where we essentially start to see buyers attempt, right? This is the start of the 1-2 punch. You're seeing trend get validated. You're starting to see these lows continuously get broken. The trend is continuously getting validated. You see you can kind of basically call it a 1-2-3 punch, even though that's a terrible 2. You can call it a 1-2-3 punch, right? Even though that's not really how it is said, but a 1-2-3 punch, right? One being that overall trend being validated, a essentially obvious leader in the market between buyers and sellers, right? That in this case being sellers. Now, the 2 would be seeing buyers trying to attempt and get essentially rejected or not rewarded, right? We start to see this candle here. We see buyers attempting to push price up, right? We get a stronger close. We get a more noticeable buying wick. Okay. So now if they are truly in the lead, we should start to see the next candles continue to push price higher, right? That should be our next sequence. When we don't see that, that's where the 3 comes in. You start to see this candle here, essentially the progress that we made on this candle. We attempted to go a little bit higher, immediately rejected, closed bearish, right? Is this that 3 where you're like, okay, now I'm anticipating we're going to go down? Not really. That would come right here, because now we're getting a truly bearish candle. We're pushing price higher. Buyers are once again attempting, right? And they get immediately shot down, right? We close bearish, right? We get a little bit of a buying wick, right? But overall, this selling wick and this bearish close is telling you that after buyers attempted, sellers regained, right? We got no reward, right? And the true reward that you're looking for to capitalize on in this anticipation would be this move down here, right? So you saw that 1, right, which was trend being validated. We're continuously showing that sellers are actually in the lead, right, as we saw here. And then you're starting to see that 2 where buyers are attempting and they're not getting rewarded, right? If they do get rewarded, that sequence kind of resets, right? Because now you're not looking anymore. Now you need to see, okay, we need to see the sequence happen again, right? And then that 3 comes back into play when sellers eliminate that attempt, right? They start to get rewarded. And now we start to see a truly bearish candlestick that aligns with both the trend, what we're seeing, who has the dominance, and is completely eliminating where buyers show up and come into play, okay? And like I said, is this for you to say, oh, okay, now this is where we go short, right? Let's just go short, and now we miraculously, take control and take advantage of this move down. No, like I say, when you're looking at price action and you're reading it, you're trying to use these context clues with what's going on to be able to aid your decision making. Like I said, there are people who scalp pure price action, right? It is possible, right? But it is a little bit more difficult to do so just based off of price action without looking at anything else behind the scenes. Because remember what we talked about in the previous episodes, how the market works. The market works by moving and filling orders in the market, right? At major highs and lows, right, we'll see participants getting filled. We're seeing their orders getting filled, right? And we already talked about, we won't go over it again, right? But we already talked about if there's sellers up here, right, and they're absorbing these buyers that are pushing price into this area, right, and they absorb all the buyers, and we have sellers still getting filled and willing to sell at this price, then we're gonna see price move down, right? That's how the market works. What this episode is mainly attacking and talking about is the price action side of that, being able to see that and decipher it through what's going on in price, right? When you see these noticeable wicks, right, seeing that sellers are not getting accepted in a certain area, seeing that buyers are not getting accepted in a certain area, right? It can give you clues to know what can potentially happen next, right? Anticipation is important. That's why with the basis of my trading style, I pair how the market works with looking at simplified order flow and looking at that on the back end with price action. Why? Because both are universal. They can be used with any approach and any strategy, especially price action. Why? Because anytime anybody opens up any chart, what is the one thing that everybody has in common, that everybody will have on their chart? The candlesticks, obviously, price, right? So that is automatically universal. And with using order flow, right, the reason why that's universal is because it's using the back end of the market to be able to see and into what's going on behind the scenes and seeing people get filled. And that's how the market works, right? That balance between buyers and sellers being upheld. Now we're able to use both the already an automatic universal factor of the market, which is price action, pairing it with something like order flow and seeing that on the back end, something that people can't see, right? But it's universal because it's based on how the market works, right? And you're able to see that information and see it play out on the back end. Now you can plug it in with every strategy. So hopefully that makes sense to you, right? So a little crash course about price action, a lot of drawings here, but overall, why does patience beat prediction, right? That's why it's important to realize and recognize the sequence of price, what it's telling you, being able to read it. Patience is always going to save you in the market, whether you're trying to take any type of trade that you want to, right? You're looking at price and you're saying, oh, we're trending down. Yeah, I see a nice selling wick in a trend down. I'm just going to take shorts, right? That's not how you want to do it, right? It can give you confidence or confluence to aid the direction that you're anticipating price to go, right? To help aid your entry model with other additional confluences, right? But overall patience and waiting for that setup and building that setup with that structure is always going to beat prediction, always. Okay? So you never want to predict. You always want to anticipate what's going on in price. Always. Okay? So hopefully this made sense to you, right? I feel like you can, when it comes to price action, you can talk about this for a long time. I was already going to be a long video, but I think it's very important to isolate the basics to be able to practice. If you want to become better with this, it's very, very important to practice this. With price action, you can go in replay mode and you can test yourself and see if your anticipation of the market, your read on the market is accurate, right? And while you forward test, you can see if your read on the market and the anticipation is there. Is it accurate? Right? Test yourself before you even build a strategy, before you even build or look at any other confluences. You want to be able to read the market, right? Things that can help aid this: reading the Candlestick Bible. If you haven't heard of it, if you want direct access to it, it's in the Discord, so you can just join the Discord. But you can look it up on Google or whatever, right? It's a longer booklet, if you will, but pretty visual. Basically, essentially outlines all the major candlestick types, what they look like, what they indicate, how they can help you anticipate what's going to happen next, things like that. So if you need to, definitely read that, right? Look it over. That'll help you build that foundation and that basis. But that's always, the skill of reading price action is invaluable, right? It's the first thing that everybody should learn, right? And should have knowledge of, because a lot of people come into the market and they trade any strategy that they just find on YouTube without knowing price action, and they're missing so much information that can help you and prevent you from taking a bad trade, a bad setup based off what's happening within price action, or aid you in your confidence to help boost your win rate and your decision making, right? So hopefully this made sense, right? Like I said, there's more episodes to come. We will speak about this again, right? And how this pairs with my main confluence, which is order flow. And so, stay tuned for that. Hopefully you guys are enjoying this series, right? My one-on-one mentorship is fast approaching. So like we talked about, if you are interested in getting personalized help and genuine personalized help, unlike a lot of these programs that you see right now, and you want to work with me personally, like I said, it's the first link in the description down below. So I look forward to seeing you guys inside, because I'm really excited to help turn you profitable and get you to the point that you want to be as a trader, because that's how a good program should be. It should be tailored to you and essentially taking you and where you are right now. And when you close your eyes and you think about where you want to be as a trader, your ideal position, getting you to that point, right, together. So I'm excited for that. I'll see you on the inside, but hopefully you enjoyed this video and this episode. Stay tuned for tomorrow. That's going to be day 5, which is going to be a really important episode. It's going to be one of my favorites, which is going to be all about order flow simplified, right? We're going to be talking about what order flow actually represents, order flow as a whole, right? Basically the broad view of it, and then what simplification of it looks like, absorption, participation, initiative, reaction, things like that. If you haven't heard of it, then that'll all be explained tomorrow. And just explaining why simplified order flow works a lot better for a lot of traders than looking at raw data that can be very confusing and very daunting to look at and try to understand. And why overall over complication ruins traders and can really set a lot of people back in their trading, right? And how simplification can really aid you in boosting your view of the market and actually just making everything make sense, right? For a lot of people trading, there's certain things in trading that just doesn't make sense. A lot is going to make sense out of this video. So I'll see you tomorrow. Hopefully you guys are enjoying the series. If you have any questions, let me know in the comments down below, but I will catch you guys for tomorrow's episode.